Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linden Associates with your agriculture update for this Tuesday, the 25th of July, 2:20 p.m. Central Daylight Time. Okay, so for those of you that get my market letter, you know, I told you last night, expect the gap higher opening, and then I wrote, will it hold is going to be the big question. As it turns out, I was right. The markets all opened good and higher. Look, you got up to 1025 on the open, kicked up to 1035 in the Nove Beans, and then right into the close, new lows at 992. And the reason that is because the crop conditions report came out, and it showed deterioration in the corn and the soybean markets. Wheat didn't matter because you're still early in there, but the cotton showed some deterioration, and that's up. Now the question is, what kind of tops are in place in these grains? And I use the word tops, and we'll get to that in a minute, that's in place there. Dollar rebounding a little bit because tomorrow we get the FOMC announcement. It's a two-day FOMC meeting taking place right now. Stock indices, for the most part, up today. Good earnings reports with the exception of Google, which because of the EU fines was down, and that's weighing on the tech sector. But barring that, things are still looking pretty good in the stock market. Energy prices, more follow through from yesterday's Saudi decision where they're unilaterally going to cut production starting in August again to get themselves down to 1 million barrels a day, reduced production, and I'm guessing export, but we'll find out. They don't talk export too much. They talk production, and the real problem is how much are they exporting. In the soybeans, on the weekly chart, you've gone from $9.25 to $10.27 and you're now having what's called an outside week down. You're down 27.5 cents for the week. You've taken out, and we'll do this right here, last week's low was 981.75. Today's low, 981. That's what happened today. So now what you've got is a market that's got a higher high clear to see, lower low. If it closes lower, if this high isn't taken out in the next 2 weeks, traders will say that a top is in, and the question is how deep might the market break because of that. When I come to an area chart of closes only, I now say we're in a down thrust. If you'll recall, yesterday I had you pointing from here all the way up here as an up thrust. But this settlement's under this last break low over here. And when that occurs, like on my swing line study, I call the thrust of the market now to the downside. I don't know how deep it'll go, but until you get back over this area right here, that peak, and if you wanted to see what that peak is, it's right here. That peak's 1027. The market's got real problems, and that's about 30 some odd cents away. When you take a look at the chart for the day, you can almost look at today's range and you've got yourself an outside day range. So what's going to happen is we'll look at that high on the swing line, and on the swing line all of a sudden your swing line's now up here with a lower low. So you have a higher high and a lower low. You've stepped out of the uptrend on the market. Now when a market falters like this, where do you think prices often run to regroup? I say the 18-day average of closes. I hit the wrong button, and that's right here at 10.0225. So you fell down, you closed under it, which is fine with me. You might even slip to the 100-day average, but the market went back to regroup. And if you take out today's action, this is where you were on Friday. Where did the market fall to find support? The 18-day. It bounced away last night and then right on through it. And that's what I was fearful was going to happen as a chartist on looking at it. Now the question is, how deep does the market break, or does it just decide to fight at the 18-day average of closes? The Bollinger Bands are doing pretty much what I told you about. They are now wrapping their arms around price because the market's out of this vertical price rise. It's now chopping around. Yes, it's broad swings, but it's chopping around, and that'll bring these bands in. Look for this number to quickly get up towards that 100-day average of 966 3/4. In terms of market momentum, pointing down. So here's what you've got. You have a market that lost its uptrend. It has no trend now. It has a higher high, a lower low. It has downside bias because it closed under the 18-day average of closes, meaning that 18-day average will become something of a barrier, a number the market's going to play around if it can get back up to it as it looks for its way, and momentum continues to point down. When we come to the meal market, like the soybean market, not a lot different. The market goes up today, gets up to 336, taking out that high, and falls apart. Takes out yesterday's low, and now the close today at 320.30 is underneath the 325.20 18-day average of closes. You're out of your uptrend. You have no trend at all. You have downside bias because you closed under the 18-day average of closes. Next support is 316.5, the 100-day average of closes. And momentum still pointing down, not yet an oversold condition. I say not yet because tonight's action could easily put it there, but being oversold doesn't mean you can't hit that first support zone. If the market doesn't want to go there, I'm going to look for more of a battleground at that 18-day average of closes. Soybean oil, let's assume you knew nothing else. What I try to teach you here is learn how to use these Bollinger Bands. If this market's going to continue its rally, 34.26 as of the close is the Bollinger Band. Market gaps up last night. 34.19 becomes the new Bollinger Band number. Remember, it looks at the ratio of where the market's trading at on that day, and this number is live. It'll switch on you. It drops down. The market gets to 34.26 just to prove me right, I guess. I'm laughing at that. And hits that number, falls back down. It's still the strongest part of the bean complex. It is still in an uptrend since it has higher lows and higher highs. And this high today even took out the 34.17. Momentum, however, is overbought and supports back at 33.44. If you take out 33.38, you lose the trend. So the pros and the pits will probably nibble on at 33.44, tight stops, and they might just abandon all that trade if it gets under that 33.38. Their job, if they want to keep an uptrend going, is to do what? Not let it get much under that. In fact, not let it get under that number. Otherwise, they've got to go through the whole cycle of trying to build what we call a trend again. In the corn market, you've developed a downtrend. The market's got now a pattern of a high with today's outside day a lower high. Now, my rule on outside days, if it's an outside day down, as we're having in the beans, the meal, and the corn, the market should not take out today's highs for the next two trading sessions. If it does, I will call that a trap for the bears, and the market often makes a run to the closest of a moving average and or a potential Bollinger Band. Now, there's another number in there called a window envelope that I use as well, so there is one more part to the puzzle that I don't discuss here. If I put those lines on these charts, number one, I don't want to, because you'll have another series of lines sometimes like Bollinger Band. You'll have lines all over the chart, and you won't be able to read what I'm doing. When you take the course, it's like a road map. It opens up, there's no fog, and bang, you go, oh, I understand that. But that's what you've got. Resistance on the corn back up at 396 1/4, but you first got to get back over 389 3/4, the potential support from the 100-day average. And remember, if you cut through what was support, it often becomes resistance on the other way. But what about momentum? It's oversold as can be. Dangerous chart to be selling. Let's assume I'm wrong and the momentum doesn't matter and you fall apart. Maybe you get to the lower Bollinger Band then, 376 1/4. In the wheat market, my problem with wheat is you were just up here in the $5.96 level. You're now 4.90s. You're at 4.99. When a market falls $1 and you're trying to get short that market, you got to be careful. What else should you see on the chart? Well, if you took my course, you'd be looking and saying, Ira, I think that this market's screaming support. 94.5, 88 3/4 at an oversold market, and I'd pat you on the back. I go, you're reading the chart right. Do you want to hang in there for the next 5 cents? Because that's the first support, the Bollinger Band. That's the question you'd have to ask yourself. I know the answer, but I don't give advice here. All I do is point out things on the chart. So the chart is bearish but oversold. The trend is down until you get back up and take out this high right here at 533.5. And from where you're at, that's quite a move back to the upside to give up. In the sugar market, in Brazil, the millers have decided that the ethanol prices aren't high enough for them to continue converting the sugar to ethanol, so they're back to milling the sugar for sugar. And when that news hit the market, you came down today 50 cents. So you got higher high, lower low. No trend anymore. You had the opportunity to embed. You didn't do it, or did you? Well, let's take a look. Let's count days that you're over 80. Both are there, and here, and here. So you did embed. Got that? And then, and this was through yesterday, and here's today's action. You lose it instantly. And I mentioned, I'm pretty sure I mentioned yesterday, this number, when you see it reopen, it could be, the way that it closed, the math of it, not the best play to try to buy the break. And I was right. The market never stayed embedded. It lost it. It's lost it so bad it's not going to gain it back without about a 100-point rally tomorrow. So it's going to stay lost, and that means you've lost your trend. In the coffee market, guess what number you fell back to today for support? 18-day average. By the way, when you ended the trend in the sugar, guess what number you fell back to? Let's go up here. You're knocking on the door of the Bollinger Band. If you lose it, I'm going to look for the 18-day average if you lose the embedded reading. I think you'd agree. What about the coffee market? If you're up here, you've hit all your objectives, you had an embedded reading, let's come right here. This is yesterday, Monday. Here's the market. If the market's going to continue the break, which I would anticipate the way that the setup's on here, lower highs, lower lows, I would be looking for a challenge of the 18-day average of closes. That number is 130.82. Yes, you slid through it to 129.35, but you ended up pretty close to it by the end of the day. And now the market is in what kind of trend? Well, because you're under the 18-day average of closes, the trend is down. The bias is down. The risk is large, 700, 600 points, back up over 136.80. And if the market wants to fall apart, 124. Momentum, pretty strong to the downside, but a lot of risk on that trade. In the cocoa market, just an overbought market that's trying to correct the 100-day average, a pretty stiff resistance point, especially the first challenge of it. You can see that was the case here. Now, back up here, it also had trouble. It finally got over it for a few days. It didn't last. So I didn't think it was going to last here either, just for that reason. And now the market seems to be headed back towards that 18-day average. In the cotton market, this market I'd be cautious of. And why? All the other grains fell apart around it. I don't know enough about the cotton weather to tell you if it's improving or not in Texas and some of the key areas, other areas. I can tell you, you got higher highs, higher lows. You're knocking on the door of the upper Bollinger Band in an overbought territory. Be very careful up here. This market could easily slip back to that 18-day average for no reason that's apparent other than to work off an overbought condition. It's nowhere near turning this to embedded. You have the K line still under 70, so neither number is over 80. It would have to do a lot of work. In the cattle market, the break today carried to the support, the close support at the 100-day average. Now, the interesting part of the cattle was the way that it opened today. The opening of the day was not a sharply lower opening. In fact, it was reasonably very quiet. And it took the whole day as it just spiraled eventually and worked its way down there. Momentum is still down. Now the market still has the pattern of a higher high and a lower low, and it's hit its first major support. The secondary big support is at 112.40, a hard market to trade on that. Feeder cattle did a better job of holding their pattern together. It's still bearish, don't get me wrong, but it couldn't get down to this 100-day average of closes, lower highs, lower lows, and resistance on rallies. I look just like it did today to hit that 18-day average and have it there, momentum pointing down. Nothing friendly on that chart. On the way up in the hogs, and the way it is up, it's up 40 points, you're still trying to develop an embedded reading. So the rally is questionable. Resistance, the first resistance point, 67.40, the 100-day average. This is the first time the market's been under it, and markets, when they first get under it, often try to snap back from that. You'll see that pattern if you go on your charts. You can even see it here as the market tried to get back under, and it's trying to snap back. The problem is, if you develop that embedded reading with it, that snapback says, okay, it's just setting itself up for the shorts that might want to attack the market. You know, as I talk about all this, and there's a lot of talking about it, there's seasonals that go into all these trends. And in the Moore Research Center, you're talking the cattle seasonals, both the feeder and the fat just kicked in on the 21st, right around that time frame of July. You might want to take a look at those. You got a gold seasonal that's kicking in right now. You got grain seasonals that have been bearish in meal and other markets, and you want to find out why that is the case. So they offer a 2-week trial. You go in, you read about the markets, you see the days profitable, days not profitable, how long the seasonals last, why they've lasted, and how they've done on past 15-year periods. So it gives you a pretty good idea. Do you use this on your own? No. I'd recommend using other indicators with it, but it's a tool. It's like asking me would I use moving averages on their own. No, it's a tool, same type of thing. So how do you get your free 2-week trial? Well, the simplest way is right through us. Just give us a call. You can go to our website to sign up for it. You can click right up here at any point in time and take advantage from there. Or underneath us on many websites it says click here for Ira's free offers. Do that and we'll put this in your hands. I'm Ira Epstein. You have a good day and I'll see you all in my other videos later today. Take care.